Hello, hello! In this video, we will attempt to answer the question, what is beyond meat? And the answer is probably going to be something like losing money. We'll see. But the company's stock price is today elevated 7% higher. If we take a look at the news, there's nothing substantial coming out. We are expecting the next earnings report, May 11. A little bit of a surge is what this article is talking about. But we don't just take a look at the price, we take a look at the business, because the price is a little bit irrelevant if the business is good. And you will notice that the 1 year high has been 160 and the company is down 76% from its high. And if you take a look at the max chart, you will see that it started nicely and it ended terribly, at least so far. So it's doing worse and worse right now, sitting at about $38 is what we're going to be getting, pre-market at least. Okay, P ratio negative, we are not starting that well. Of course, negative P ratio means that the company is losing money, very bad sight to see. And the price to free cash flow ratio, also negative, company also losing money at the same similar rate. And outstanding shares that are increasing tremendously, 50% higher in just a couple of years or so, that is. And yeah, the company has been printing shares like crazy because they do want to be getting some extra funds. And while the company stock price is massively elevated for no reason, it is then when the company will have to be issuing some shares, and they're gonna be basically diluting you as an investor. It's terrible for you. Now, free cash flow to total liabilities is negative because there is no free cash flow, and the 5-year revenue growth is increasing. Net income growth is going down though, and free cash flow growth also going down at a similar rate. And equity growth has been going up, and you may be asking how this happens. This is how it happens. Outstanding shares keep increasing. Pretty much this is a company that is funded by investors and it's not really making money. Now, the debt to equity ratio is also very high, very high, super high debt here for the company. And look at these returns, basically all negative and no margins, pretty much all negative here. If we take a look at the financial statements of the company, you'll see here that it is increasing its revenue, but if we go down, it is decreasing its net income. So it's actually getting more revenue and worse net income. And if we take a look at the balance sheet of the company, you will see here that the total equity has been increasing slightly, although still going down. And that's happening because of the additional paid-in capital, because people are willing to invest in this for some reason, and they are getting some money through that. Now, if we take a look at the cash flow statement, we are starting with a negative net income, and so we are continuing with negative operating cash flow over here, even though some depreciation and amortization is added back and some stock-based compensation is not even enough to make this value positive. And so we're having negative free cash flow, piling up pretty much year over year, and that's last year is actually their worst year ever, it looks like. And if we take a look at the cash from investing activities here, you will see that they are still investing some, and yeah, this is operating, sorry. They are still investing some in investments and in property, plant and equipment over here, and some capital expenditures. And also they're financing themselves, again, taking more debt. Look at this, one extra billion over here. And yeah, this is a massive debt. They need to be getting some debt because they cannot fund their operations. Look at this increase in the financing activities cash flow, pretty much coming from the debt. They had just marginal debt before, in terms of at least what they were getting for that year, and now they're getting an extra billion, because again, they need it. They will either have to get some debt or finance their operations through extra shares, or both. This is probably what they are going to be doing. So things are looking dire for the company. And if we take a look at the stock evaluation tool, this is a company that it probably doesn't make a lot of sense to potentially try to get to profitability here. Looks like we are far from that. Look at this, minus 93% net income margin, and minus 33%, and when it looked better, then it looked bad again. And this is typically what happens with non-profitable companies, not the opposite. Non-profitable companies tend to continue being not profitable, and you may have a good quarter, a good year, and then go back to being negative. And this will happen with most of them, and then there will be the odd one out, like Amazon, which will do amazingly because they had an amazing business model and all that. But this is again the odd one out that you cannot predict it as a retail investor. really, or even as a sophisticated investor, you cannot predict it. And so it's better to stick with companies that are making free cash flow, making good money, making good net income, and avoid this kind of pitfalls here that can really cost you your portfolio. And so in this one, again, it probably doesn't make any sense to try anything here. Look at these free cash flow margins here, terrible. And I mean, the free cash flow margins you are looking here, they are positive, but they are practically speaking negative because both net income and free cash flow are negative, and so this becomes a positive value. But practically speaking, is super negative because take a look at the growth here. Terrible free cash flow, terrible growth, going down and down. There's just not even a reason to try to get some projections here. This is a company that I would avoid like the plague here. It's looking very dire. And so I wanted to make a video and talk about it because it's in the news, it's being discussed a lot, and people may be thinking about getting some of it. Not a good idea if you ask me, but you need to see the financials with your own eyes, and hopefully that video shed some light and kind of helps you a little bit, especially as the stock price is up 7%. It may actually feel like it's a good opportunity, and it's not. If you take a look at the financials, if you spend the time to take a little bit of a closer look at what's going on with the company, things are looking very bad here. Again, I would really avoid messing with this one because it can really hurt you. Thanks for watching the video. I hope you liked it and you enjoyed this kind of analysis. Please leave a like if you did, and remember to subscribe if you are not a subscriber. And in the meantime, take a look at the video that I made earlier, and in that one I'm discussing ARKK and the disaster of a fund that it has been. Thanks again for watching. See you soon. Bye bye.